Forbes Books presents the Startup Science Podcast with Gregory Shepard, brought to you by StartupScience.io. Greg is an entrepreneur who has built and sold 12 businesses. He's a recipient of 4 private equity awards and is a featured 10X speaker and Forbes author. Here's Gregory Shepard.
My guest today is Chris Van Dusen. Chris is the senior partner at Solyco Capital, a vertically integrated investment firm that takes a unique private equity approach to venture capital. Chris, welcome to the podcast.
Oh, my pleasure. Thank you so much for having me.
Yeah, I mean, you have an incredible background, and it's a real honor. So maybe for the listeners, you could start out by sharing a little bit about your background and how you got involved in the VC world and private equity and all of that stuff.
So you mean my non-linear journey as a
a dynamic approach to your journey.
Yeah. So as I said, non-linear is the best way I like to say it. So grew up in Connecticut, went to college at the College of William and Mary, graduated with an economics degree. Certainly, Greg, the more you get to know me, the more you'll know I'm not someone who goes and sits behind a cube after college. So an analyst was not the job that I was going to get. So I started in sales, ended up doing sales in the financial world as a wholesaler, moved to California in 2009, about 7 years after I graduated. And company I came out for, let's just say, ran into a smidge of financial trouble. So I'm marooned out in Newport Beach, California, not a bad place to be, but big difference between that and Williamsburg, Virginia. Ended up starting a marketing firm. I met my wife a few years earlier, and she had started one as well. And we did conversion rate optimization and high intent media buying, staples of marketing today that really just kind of weren't that back in 2015. And we scaled that up, worked with a lot of amazing brands. And, through a mutual friend, met these 5 guys. And they were endeavoring to start a CBD company. They had started at the end of 2016. I joined them as the initial and first CMO. And within a couple of years, we had scaled that business up quite dramatically. We ended up being the second largest CBD brand in the world behind Charlotte's Web. And it was a fantastic time. I learned what it meant to do a parabolic rise. And then as you look at discretionary spend around COVID, parabolic compression. And it was just a very interesting time. I got a master's degree in what it means to scale and reduce, if you will, within a year.
At the same time.
At the same time, you're right.
Yeah.
At the same time, my wife and I co-founded with another couple a liquor distillery here in Huntington Beach, where I live, called Surf City Stillworks. Raised some capital for that. We had also built another beauty care brand in the CBD space that we had merged with my original company. Now, we sold the CBD brand in 21 to a publicly traded company, and we did a merger with the liquor distillery in 21 as well. So I'll tell you, if you've ever tried to do 2 transactions in 1 year as an operating lead, it's quite a bear, let's just say. And then I had a friend of mine from college. We raised 2 funds in the cannabis space at the same time in 18, 19. All around picks and shovels, ERP systems, analytics companies, accessory companies. I was kind of fascinated by the build versus buy model that would happen if you're kind of bullish on federal legalization long term. And so kind of back up 2 seconds, back in 2017, I joined this group called Alder. It's all around generational leadership. And it's really, there's an old Greek proverb goes, the world's a better place when old men plant trees whose shade they'll never enjoy. And that's really what the group's about, right? A collective of individuals across the country who come together and try to make the world a little bit better place. At that time, I met this gentleman, John Garcia, who was starting this firm called Solyco Capital. They ended up being an investor in the liquor distillery, so they watched this come full cycle, as well as, we just became friends and would talk quite often. And after the last exit in August of 21, he asked me if I wanted to join as a senior equity partner at Solyco. And fell in love with the firm, fell in love with the ethos. It's a very gritty firm. And what I mean by that is we love operating and helping, as all of us being ex-operators inside of our portfolio companies. So we take this private equity approach to venture, much different than traditional venture.
I mean, I got to tell you, it's so great to hear that somebody in venture has been a founder. There's so many people in venture that are telling founders, what to do, giving them advice that have never, ever driven the bus before. The fact that you're a serial entrepreneur is just really incredible. And that by itself differentiates you guys dramatically from the rest of the world, right? They're all out there, you're talking to some deal hunter, they get on the phone with you, they want to raise, they don't know anything about, they're just making overrides, right? So they don't know anything about it. And then they just work through the process and get on a monthly call and harass you. And you're on the other side of this as a founder, having experienced that, saying, let me help you. It's really beautiful. Let me ask you more about that. Like, how do you guys actually operate in that way in more specific details?
Yeah, so we have a large firm, all things considered. So there's 11 of us senior partners, and we have about 40 staff. And so it's quite a large team, but multidiscipline operators, actually working in operations, finance. We have a tax division. And so, as we engage with companies inside, and end up inside of our portfolio, it's by no means mandatory, but we are there of service, and we'll go in and help drive. We like calling it, going faster on less fuel, to use a race analogy, right? And the way we look at it is kind of twofold. We'll go in and for a fee, right? For service. This would end up being what you'd consider a management consulting firm in helping them, early stage. But in a lot of ways, the deals that we structure, we don't charge a management fee, or we have a one-time management fee up front that isn't a 2 and 20 model.
Wow.
And so for us, we like saying our interests are aligned a lot differently than a traditional kind of 2 and 20 venture. But more importantly, we can go in and our interests are aligned with founders. We're already an investor. We are proven operators in our own right. And we have a team that are just as good as we are, right, as partners in helping drive. And that could be by offsetting part of your accounting team. It could be being an interim CFO or CSO. For me, my first year at the firm, I was a chief revenue officer, which is really where I sat, right, from a C-level position inside of these companies, driving what we were doing on our product mix with the product team, driving and putting operational rigor around marketing spend, helping hire, the VPs of sales and marketing. And then 6 months, 8 months, whatever the term is later, they don't need a full-time chief revenue officer. They needed someone to come in with the expertise to drive that piece for that period of time and put the people, align, the board with where it's going with all the different parts of the team, and you're out. And so that provides a lot of value. And to be frank, if you look at a lot of early stage companies, the quantum of cost for a talented lead in a role like that, especially in called the LA market or the New York market, is extremely expensive when you add full-time salary, full-time FTE carrying costs, plus stock options and all the things that, great startups do. Well, we're already in, our interests are already aligned, and we just get in there, roll up our sleeves, do the work, and help that company move forward. And when you look at the totality of the cost, it ends up being, a fraction of what it would be to hire that lead that now you may have outgrown at some point, because these are these formidable years of seed through B. These formidable years, you may have outgrown their skill set, or you needed a different operator long-term, and they don't have to necessarily deal with that during that first period.
This is really cool, like really, really cool. I've done a massive amount of research on this whole subject. I wrote a book about it, and it's extremely rare just to have the investors having even done a startup, let alone offering fractional services as part of the investment. That's this is really extraordinary. I wonder, you're from the CPG space, so what do you guys usually look at? Are you into tech? Or are you just into consumer goods? Or do you guys have a certain focus for the founders that are listening?
Yeah. So what's really interesting about our firm, even further than maybe even saying we don't have those management fees, right, is we don't have necessarily a mandate or thesis against what we're doing, because we don't raise a fund. When you think about going out and raising a fund, it traditionally has a mandate, traditionally has a focus. For us, we're able to go out and identify great founding teams, right? We invest in people as much as investing in platforms and others. Amazing teams, amazing opportunities, amazing, let's say, total addressable market. And do we believe the founders can do it? It's much more intensive diligence process than what I'm saying right now. But then we go out and we build a deal and raise the capital for that one deal. So we have in our portfolio fintech, property tech, we have AI, we have hospitality, we even have some straight play real estate. Really, at the end of the day, it's where we can find amazing alpha for our investors and be able to bring the kind of totality of our value as a firm to help drive those companies forward. And so we work on, traditionally what we've been doing is an SPV model. And then we might have 8 companies within our portfolio that are raising their next round, and we'll put those together in what we call a portfolio SPV. So very different than a fund in that you can see the 8 companies, you can see the growth, valuation, forecast. It's not a raise against a thesis saying, we're going to raise $100 million and we're going to deploy it against these type of companies that fit this certain thing over the next.
It's like this company.
Yeah, this company.
Yeah.
With this performance, these projections,
this team, everything. Yeah.
Very different.
Dude, that's so cool. Like, I like the syndicate model so much better because the traditional fund model is the same as wealth managers, right? You lose, they make money. You win, they make money. Like, they make money no matter what, but you're aligned with them. You're a real partner, right? It's almost like rev share, right? You're a real partner in on the deal, and you're offering all these services and expertise. I mean, this is I need to come and see you. I'm in San Diego, so I need to come and see you because this is like so cool.
What's interesting, and I'm glad you brought it up, and I'm not going to sit here on a platform of, traditional venture is broken, right? That's not the platform I run on. But I think you brought it up perfectly. Incentives are aligned when we, as a GP, make money when our investors make money. We're aligned with our founders when we're in helping them grow and helping them steward their vision forward. And because, in my opinion, and what I've seen at least, being an investor in deals way before I joined, and on the GP and as a venture partner, most deals take way longer than you ever expect them to. But most funds have time mandates that they need to turn capital. And we can go into I'm sure, another whole podcast on why they need to turn capital.
Yeah.
Right. But it becomes very different, right, for how we approach these companies. And, the home office for Solyco is out of the Midwest. And I like to talk about the Midwest values, right? Our founder, John Garcia, talks about kind but fierce, right? Like, that's the ethos of this firm, is to go in and really, again, interest aligned, but truly drive value, not only in the capital stack for our investors, but also certainly for the founders and the ecosystem. And that ecosystem is important. We have about 32 companies in our portfolio today. And we look as part of the due diligence process and say, hey, how can we help scale? But how does this company fit inside the greater Solyco ecosystem? And how are their partnerships? And how can we power broker deals? And how do we put things together to help all ships rise? And it becomes a very unique way of, looking at it. We don't think of it as a zero-sum game.
Yeah. I mean, the involvement that you have, like, just that is crazy, right? I mean, usually they'll have like the entrepreneur of residence, and this is usually a one-hit wonder, right? And they throw them in there and they go, okay, yeah, we give you all this help. And then they put some cat in there who doesn't really care. You have a vested interest. You got skin in the game. It's dramatically different. It's a really cool model. I wonder if I want to kind of go backwards to go forward. So
Sure.
You, in your own right, you've had several exits, right? Is there anything that you could tell investors and founders that are listening to the podcast about what you learned during this process, about what are the most important things from those two perspectives? Because, the investor's looking through their glasses, the founder's looking through their glasses. You have experience on both sides. It's very unique.
There's a lot. So I'll just start with, there's a ton. But the one of the biggest things, don't try and do 2 at once, by the way. If you're an operator, that's really tough. I have a lot of gray hair, scars, and maybe a bout of alopecia to share for it, right? That happened during the time. It's all come back now, but very stressful night. But really, don't overpromise. And I think that's the toughest part. Because if you think about the seesaw that we're both on when you're selling a company, as a founder and certainly an investor or being on the board, you want to drive the highest valuation possible. And traditionally, that's a multiple on valuation, a multiple on EBITDA, something, right? As a buyer, you want to spend the least amount you possibly can to acquire something that will give you the most value long-term. Our interests are aligned, and we're always doing this. And that's usually where massive tension comes. Everyone hugs in the first meeting, everyone fights, and then hugs again after the ink starts drying. But in between, it's really tough. And if you think about from the founder's point of view, trying to drive the valuation up is to focus on where the company is going. But what most people forget is this isn't a handshake. you sign some paperwork and you're done. These deals can take 6 months, 9 months, a year to truly get through, which means on the buy side, you're having 6 months, 9 months, 12 months to watch the forecast come to life. And it's always better to do better than, to exceed expectations, than to be falling short even by a small margin for things you can't control during seasonality or other things that you may have incorrectly baked in throughout the transaction. And so I would say, don't forget you're going to get retraded if you do not hit those actual forecasted benchmarks around the way. And that becomes a tough pill to swallow when you have a number that you're driving towards a transaction. And, within the last 30 days of the deal, they're going, now we're going to offer you 10% less. And you're so tired and so exhausted for going through this process.
The old deal fatigue.
Fatigue.
Yeah.
And people just go, fine. Right. And there's, you can watch other podcasts, you can listen to tons of stories, read papers on it. It's very common. And the way I've seen that not happen is to be really focused and transparent on executing, which is the hardest thing to do when you're also having management meetings and getting data rooms together and having to explain files in data rooms while you're trying to work with your team to continue to hit all the major milestones within that period. And so it's just be really realistic on what your company will do during the period of sale is, I would say, a very big lesson.
Yeah. I mean, it's like it's pretty much a full-time job. Just doing a deal. I don't know how you did two at the same time and run two businesses. That is mind-blowing. I'm surprised you didn't have a heart attack or something.
Really, I was probably about 35 pounds heavier than I am now too. Eating junk food and staying up way too late. But
yeah, I get it.
Fix that, I guess.
Yeah. So why don't you tell me a little bit about the specific industries and verticals that you guys are focused on, if there are any? You said previously it's pretty much open, right, to anybody. Is there anything, and I'm talking on this side, I'm talking to, the LPs and the angels, right, that are like, I like to focus on this. Maybe you can say, well, the majority of what we're seeing, because, you're a victim of what you see, right? So, what we're seeing now is this, so we're making investments in this space just to try to get their attention on, well, maybe we should make a phone call to you guys and,
as we look across the portfolio, you look at a few kind of trend lines that come through. We have a few in sports. I think that's a very interesting topic. We haven't gone to the place of doing, minority deals in teams or leagues that are starting to come over, but you're seeing more and more globalization of sport. And as you see that, you're seeing a really interesting new leagues like Padel coming over from Europe that's very hot. And it's like pickleball and racquetball kind of merged together. It's a fantastic. And for the Padel lovers, they'll probably send some nasty messages for me saying that. But optically, if you're not familiar with it, think about that. But looking at the numbers in Europe coming over, it's really taking a foothold in New York, and they're trying to scale that. That is a very interesting opportunity in a new league. Sports tech around recovery, and then certainly AI in sports is fascinating. We've made an investment in a company in that space that we are extremely excited about. But we have a few in sports, I would say. Industrial manufacturing is a big spot for us, right? We have a great company, Paltronics. It's a smart pallet company. Fantastic industry, first of all, because the whole world runs on pallets. Every good and service that we both have on our walls and in our offices came on a pallet at one time, right? But you start looking at some of the inefficiencies in the business around sensors and the technology around it. And you think of Chipotle with their E. coli scare, and where's the actual temperatures in the cold shipping, not at the pallet level in the truck. If you can build a sensor technology built in, which we have, and make a pallet that's as light as wood but as durable as plastic with sensors in it, that becomes a very interesting play. And so that's a company we've been invested in for many years. We love platforms. So there's another company, Free Power, that does platform charging. So if you think about going to a conference, going to a restaurant, going to a hotel, actually, Greg, just you being in your office right now and setting down your phone and having it start charging, right, on platform. It becomes a very interesting opportunity. And they're endeavoring to make it as ubiquitous as Wi-Fi right now. And you might say, well, I see these charge mats that are all over the place. You can buy them direct to consumer on Amazon or somewhere else. Well, it comes down to the technology, because the original, technology for wireless charging is that magnetic ring on the back of your phone meets a magnetic ring on a pad, and they end up overheating, and they're not aligned. They barely charge. They developed this amazing technology with repeating coils, firmware, hardware, software that you can put down an Android, an iPhone, AirPods, and it builds the ring under the actual device, knows what it is, and starts charging it at the highest peak rate.
Wow.
That becomes a very interesting technology mixed with being built into countertops, being built into desks, being built into new smart homes, smart hotels. And you look at where we're going, that becomes the technology du jour for powering devices and charging devices all over. Fascinating company. We have a company, EV Mode, here out of California in Irvine, that's doing EV chargers. Now, there's no lack of EV chargers, right? But one of the biggest problems in EV charging is the fact, and I used to have an electric vehicle, that like 60% of them are down at any one time. So you think about the infrastructure, you go up and it says there's 4 available and there's 1 or 2 and they've all been taken, right? And I had that happen to me many times, sitting for 45 minutes or an hour. They built a better product, military grade, certified product that has a 99% uptime, and then worked on a different incentive plan for the installers and for maintenance and how it works. And they're working on, the level 2 and level 3 chargers. Like, that's a very interesting way of looking at an existing market and finding a piece that's not being addressed. And so we look for those type of things. We have another fascinating company in biotech that invented a novel way of, taking new medicine. And they're working on some great licensing agreements right now as a technology. So we really have these different companies in different industries, but all are trying to solve something in traditionally an existing industry that's not being addressed. And that's what we get excited for.
Yeah, you have really good like industrial transformation. You have the pallet deal, which is huge right now.
Huge.
You have the AI, which is just kind of in everything now. You have the charging thing, which is a big deal. They should make a charger so you can drive over it in your garage instead of having to plug in your car. That would be amazing. Yeah.
So it's one of those that, and I'm not saying anything out of the bag, but like you can see it going there, but the massive amount of, and this is probably, I'm over my skis on a knowledge totality, but I will tell you what that would have to be to just pull your car up and have it start charging would be a monumental feat, but I don't think impossible within our lifetime.
Yeah, I think so too. You could see them in parking lots. You just drive up, it's charging while you're, it's an interesting idea. So let me ask you a little bit about some of the decisions that you think founders make that are bad decisions. One of the things that I specialized in is I did this 5-year research project on why, when, and how founders fail. So a lot of what I try to do on the podcast is really tell founders like, hey, don't do this or look out for this. Maybe you could give them some advice.
Well, so my question would be, what percentage of the companies in your research had founder infighting as a reason for failure?
Oh, it's like 28%.
That is a big number in totality, right?
It's a huge number. It's almost a third, right? It's a massive number.
You get married to this vision that you share. And if you think about the amount of, just to be frank, divorces that happen in this country, they had a shared vision too when they started. And sometimes as life and as direction goes, they start veering away. And founder infighting for truly where the company needs to go becomes a big thing that we look at, is that chemistry, because you're picking your dance partner, right? You're picking the person that you're hoping knows what lane and what part of the company they're in charge of. And the other person knows where their lane is and what they're in charge of, and they work together beautifully to go make the thing that they've endeavored to do. I would say understand who you're doing this with really well, and make sure your values, interests, how do I want to say this? Your amount of effort you're willing to give to make this successful are aligned, because it's tough. I mean, if you're the capital partner who has no expectation at the beginning to do anything on a day-to-day basis, then there should be very clear lines that you're not going to be there grinding on this new project. But if you're a 50-50 or 51-49 partner that is sitting there supposed to be looking at each other again, across from a desk, working and grinding, and one's off doing liquid lunches on Fridays and hanging out with their families. No offense to that, right? Like I understand it. And the other one's sitting there for 14 hours grinding. That's going to take its toll over the long run, and traditionally does. Number 2, define your lane, do very well in your lane as a company before you decide to go do something else, attack another vertical. So let's say you're doing, a B2B SaaS company and it is designed for, XYZ group. What I see happen a lot of times is they go, yeah, but we can also go into this other area or this other area or this other area. And with limited resources, they will try to do that, not realizing the speed to sale or the incumbent foothold is a higher mountain than they can climb with the resources they have today. And they wasted time, energy, money, just fully opportunity costs going and chasing that new thing versus taking that same quantum of effort and putting it and doubling down into what they're doing really well and building a moat around what they have in their one vertical, showing that, and then going either raise capital or utilizing, revenue to go scale into one other vertical. But you find they go to 5 or 6 right out of the gate because they can try to pick up little bits of revenue. And then they're, an inch deep and a mile wide instead of being an inch wide and a mile deep, which those footholds help you be able to do the next vertical to show proof points. And I think rushing to say we can do it all is a huge lesson that I'd say certainly we learned as well in different companies that I've been involved in.
When I look at deals, right, I'm looking at the horse. I call it the horse and the jockey, right? So you can have an incredible horse and a jockey that falls off, or you can have a really great jockey and an old donkey, right? So when you're looking at these scenarios between the horse and the jockey, right, sometimes you're like, okay, well, the jockey can't ride, but maybe if they lose some weight and then I teach them how to ride, then they can ride the horse. How do you guys assess and evolve this situation? Because sometimes you're wrong. You think you have a great jockey. It turns out that they speak really well and they seem like they're on point, but then execution seems to fumble. So how do you think about that, and how do you work with the companies to help these two things along, and which one do you focus on more than the other, or is that even the case?
Yeah, so I'll probably start from a due diligence perspective before we get into actually like working, right? One, naturally, if they're on their second or third, that tells me they have the executional prowess to do this again. So it's not that they get a free pass, but they certainly get a little asterisk, right? Which says, you've already done this a couple of times. You know what it takes, right? This isn't, because there's a Pollyannishness, I think that said that word right, to thinking I want to be an entrepreneur, having a great idea, but not understanding what it truly takes to get it done. Because it is
the struggle.
It is a struggle.
Yeah.
It is a journey. And, it's not one for everyone. And I'm not one of those individuals that stands up and says, go be an entrepreneur. Like, there has to be a level of craziness that says, I'm going to almost recklessly abandon a comfortable life to go add some really hard stuff into it on a daily basis that is most likely statistically going to fail or not be sellable. I've just built a lifestyle business, and that's great too. But also, like, it's not the dream I had. But number 2, and it was actually one of the GPs at Benchmark, and forgive me, I forget his name, but said a great thing. He goes, where founders make mistakes is if they're building a sailboat company, they want to tell you about the rigging, they want to tell you about the beams, they want to tell you about the galley, and they want to tell you about all the things that make the sailboat. What's actually most important is sell me the wind. Because if the wind is going, it will make all boats launch. And you have time to change your boat in situ, like in flight, but you do not have time and you do not have the ability to change the wind. So show me the market, show me what's possible, show me your ideas on where this is going and why you're a perfect fit, because there will be more boats just like you that are going and attack it. And you can get really smart and figure out how to dial your boat in to get there faster, be bigger, be stronger. But if there is no wind, no one's going anywhere. And that becomes a really interesting point. So we talk about it a lot of especially in diligence or when I'm having management meetings, like really describe to me this market and why you think this is going to change, right? And, we have a company in, I'll call it property tech, kind of reworking owning of your primary residence. And they built this financial instrument that allows you to do some very meaningful things. And we spent so much time focusing on their buy box and what that means across the country and what that means for the people who own these type of homes and why this is the largest piece of their retirement and what that means if they could unlock extra value out of it over a 10-year period. And like, it had nothing to do with their company. It had everything to do with what's happening in real estate over the next 20 years and what's happened in the past 20 years and understanding patterns and understanding what it can unlock. And, and you're starting to see some things in the news, not about that company, but about things that people are locked into their homes and all this. And it was a bet for us, and it was a big one from a totality of investment dollars, but we believed the wind. We believed the market. We believed what they were saying, and we believed this instrument was sound to be able to capture that, and they are off doing that. And it became one of those things where it was focusing on the market and their ability to deliver. And both founders are serial entrepreneurs who had been working on this as a passion project for 4 years while they were operating and, gearing up to sell their company. And you go, this isn't two guys sitting in their basement who had a good idea one night. These are guys who are, serial entrepreneurs who have done this before, who are in this market before, who have seen this gap and no one address it before. And then they're explaining the market in a way that you're going, that's undeniable, that's there and coming. And you guys have built an instrument to help address that. Well, that's an amazing marriage, right? Like that's an amazing piece together.
I mean, this is so cool. And I really hate to do this, but we have to stop here. Coming up next time on the podcast, Chris Van Dusen, senior partner at Solyco Capital, will discuss the vital role of cultivating connections when building a startup.
We love these deals. We put our own money in the deals, and we want to have this great ecosystem of people that want to participate in helping this next generation of entrepreneurs build wonderful, amazing companies that could transform the world. And when they feel that and see it, it all comes down to that relationship as well.
The Startup Science Podcast with Gregory Shepard is brought to you by startupscience.io. Founders can log on to startupscience.io and use code FORBES to get free access. To connect and find out more about Greg, go to gregoryshepard.com. The Startup Science Podcast is a production of Forbes Books.